Good morning, friends. Continuing our lecture on the topic of fixed income valuation of fixed income securities, I, CA Ashish Gupta, Deputy Director Board of Studies, will continue this session. Student, as I told you in my first class, that this topic is basically fixed income valuation, and under fixed income valuation, we shall cover both our bonds as well as our money market instruments. So we have started our discussion with the money market bond valuation, and we have discussed some numericals with you also. So student, today I hope since in assignment I have given some questions for your homework, so I hope you must have got the correct answer. So before we start our, I think we have done many questions. If I recall that we have solved up to say 5 questions we have solved, and so now today let me check up to what questions we have solved, then we shall proceed further. Okay, Manu. Now this question I have given to you for solving. So please let me know whether you have solved the questions or you have got the correct answer, because up to 4 we have solved. Okay, now let us start with the question number 5th. Student, when we talk about the question number 5th, please see the question is like that. An investor is considering the purchase of the following bonds: face value 100 and coupon rate is 11% and maturity period is 3 years. Now, if he wants the yield of 13%, then what should be the maximum price he should ready to pay for it? Okay, student. Now I hope you must have solved this question. So please, if anyone has solved the question, please share the answer with me. Let me check. Okay, student, no problem. I think I will start with solving the question. Now, student, in this question it says the coupon rate is 11%. Okay. Now, if he wants a yield of 13%, so what should be the price ready for to pay it for it? Of course, you will make the calculation, but while you are carrying the calculation, you must have got some idea, because when I was discussing with you that there is a inverse relationship with the yield. Okay, if the yield is higher, okay, so the value of the bond will be lesser. Okay, if it is if you recall that, then I was taking an example like it is like a par, then it is at a discounted. So similarly here, our yield is greater than coupon rate. So of course, the value will be at the shall be at discount. This is a first hint. Okay, even though if we got it the answer, but my advice to you, just make your own observation also. Okay, so now let us find the value of the bond. Okay, let us see. That is calculation of the maximum price he will ready to pay. Now student, as I told you, you can do it the both way. You can solve it in a tabular form as well as equation form. If I opt for equation form, you need to mention the word in the examination equation form. It is well understood. My coupon is 11%. Of course, the interest payment will be rupees 11. First, my cash flows. These are my cash flows. That is into present value investment annuity factor at the rate of 13% for the period of 3 years, plus my repayment of interest. Now, student, please recall, normally I have observed sometimes student commit a mistake. They take this value inclusive of the interest. It is a common mistake that I have observed. Sometimes students they use rupees 1111. Okay, this is completely wrong. Please remember, because here when we use a tabular form, please not here. When we use a tabular form, normally what happens? Here the year is there 1, 2, 3. Of course, our cash flow is there because it is based on a capital budgeting techniques. So here only we are concerned with the cash inflows, and in the terminal year we include both interest as well as principal. But while we are using the equation form, the first part take care of our interest recurring annual cash flows. So here you need not to do this. Okay, so just please remember, don't mix it. Okay, so when we solve it, let us solve it. Okay, can any student give me the answer? I'm waiting for 1 minute. Yes, I'm getting 1 or 2 correct answer nearby. Student, here the present value investment factor will be 2.361 because we have added the PV factors at the rate of 13%. Okay, at the rate of 13% for the 3 years. Okay, if you can do it on calculator, you can do it by using the grand total. There is one procedure. Student always follow the same. Or you can write it down the way you like. Okay, but please remember, always use the decimal point. If nothing is mentioned up to 3 decimal PV factor up to 3 decimal points. My principal repayment is 100 into present value factor into 693. Okay, student. Now here, another it says that if the bond is selling 97.60, then what would be his yield? Okay, so we can solve it anyway. Either we can use the shortcut. There is a one shortcut method that I will also discuss with you that we used to normally follow in our at our intermediate level. So let us calculate the yield. Okay, student. Now here we have to assume some arbitrary rate. Very good. Yes, your answer is correct. Naveen, Harshad, very good. Now, student, now when he is selling the bond is selling at 97.60. So here we have to assume some rate arbitrarily. So please remember, when we have to calculate some rate, so you just take some rate nearby your coupon rate. Okay, don't take too much far of speaker. Okay, now let us say we can say that let us discount it at the rate of 12%. Okay. So at 12%, our value will be rupees 11. Okay, I can do like that. If I want to follow the NPV like method, just I will show you. Percent value investment. This is not NOT, this is my mistake. It is percent value. Yes. This is percent value investment factor. Okay, if I take it as a at the 12%, my value becomes 2.402 plus rupees 100 into 0.712. Okay. Now value comes 97.62. So student, we can say that the value is somewhere near about 97.60. Okay. So we can say that the yield, since you can write there, since the present value since the present value of cash inflows from bond is equal to the price, the yield will be 12% approximate. So you have to go further. Okay. Or there is some shortcut formula that I am discussing with you. Interest plus redeemable value somewhere near about 12%. But please remember this, use this formula as list to list, because normally it is always expected that sometimes, of course, if this question is say for coming for say 4 marks, okay, then of course you can use this method. But if it is coming for the 8 to 6, 6 to 8 marks, so please follow the proper IRM method. Okay, student. Now let us go to the question number 6. Now in this question it says, 1 minute. Sonic Limited issued 8% 5-year bond of rupees 1000 having maturity of 3 years. The present rate of interest is 12% for 1 year tenure. It is expected that the forward rate of the interest for 1 year tenure is going to fall by 75 points and basis points and further 50 basis points for the next years. This bond has a beta value of 1.02 and is more popular in the market due to less credit risk. Okay, now we have to calculate the intrinsic value of bond and expected price of the bond in the market. Okay, so this question contains 2 parts. Okay, so one is that this part is related, expected price relating to basically this portion. Okay, but for this portion To calculate the market price, we need to calculate the intrinsic value. Okay, so first we shall compute the intrinsic value of the bond. Intrinsic means the straight value or the fundamental value. Okay, students. Now let us see. Now here, student, up till now, till the previous questions, we have seen that our rate yield was stable. Okay, our yield was stable for every year. Okay, now let us, like, if we go by this question, here we are considering 13%. Okay, the yield is 13%. So 13% is same for 3 years. There is no change. Similarly, if we go by this question, even if for this question the tenure is a 5 year, okay, and our yield, different yield has been given, but this different yield has been stable for 5 years. This yield is for 5 years. We are 9% we are assuming for the 5 years. Same. Okay. So we have computed the answer in 4 scenarios. But this may not be the situation practically. Practically, because if we assume like that, the interest rates are same, yield is same. So it is called flat yield curve. That will be the topic of our next topic for our discussion. So what we do, we normally practically we follow, there is a different yield for different years, and accordingly we have to compute this value accordingly. Okay, now let us see the solution. First of all, if the tenure is of beta 3 years, we shall first calculate the yield for the 3 years. Or we can say that not yield, but we can assume it is as a, okay, of course we can. Okay, but just you avoid the yield because not that. Let us forward rate for the 3 years. First we compute the forward rates. Okay, beta. Now let us see our year 1, 2, and 3. Now it says that the yield will be first. Initially, it will be for the 12%. Then it will fall by 75 basis point and further 50 basis point next year. Okay, students. So year 1 rates. Now, student, please note there is a lot of difference here. The term forward rate has been used. So please remember, if we use the yield, so for yield we shall use a same discounting rate. But when we use a forward rate, so for different years we have different forward rate. Now I will show you how we shall compute it. First, it is at 12%. Okay, next year it is 12% minus 75 basis point. As I told you, it will be 0.75%. It will become 11.25%. Next year onwards, it will further fall to 50. Okay, so here 11.25% minus 0.05%. So the figure comes 10.75%. Okay, students. Now let us discount the present value of interest. We compute the present value of interest. Okay, student. I think it will be better if we first discuss the concept, because I think I will have to leave this question in before, because first of all we discuss the concept of forward yield curve, then I will let you know. Okay, just hold on. I think it will be better if we do like that. Okay, student, now read the slide carefully because after that we shall discuss. First of all, initially for half an hour, I will discuss this term structure interest rate. Then I will solve the question with you. Then it will be more easy for you to understand the question. Okay, students. Now in this it says the term structure of interest rate, also known as yield curve, shows how yield curve is related to terms to maturity for the bonds and that are similar in all aspects except the maturity. Now students, when we are solving the question, okay, so we have come across that this much of yield. Okay, so the term structure means it can be said that it is kind of a yield curve that is mainly for the discounting the cash flows. So in our previous example, we have given the fixed rate, whereas in case of another example, there are different forward rates. Okay, when we combine forward rates, we got the yield rate. So now let us see. Now further, you just read the slide carefully. Yield curve, however, do not necessarily slope upwards and downwards. They follow the different patterns. Now, student, what happens? If we assume that our interest rate will be same as we have normally about the question in this, so we have assumed that our interest rate was same for each year. So in that case, the shape of the curve will be like that. That is called flat yield curve. Okay. Now suppose if we have assumed that interest rate is 9%. So suppose if we value the bond of for 1 year, 2 year, 3 year. Okay, this is the tenure of bond. Okay, either it can be 1, 2, 3, so long. Okay, in that case, what happens? So far as this tenure is concerned, even whatever the tenure, our rate of interest for discounting the cash flow will be the same. So this is the flat yield curve. It is called flat yield curve. Okay. There is another version. This is called upward sloping. Okay. Now in that case, suppose if we are want to compute the value of the okay student. So this is the shape of the upward sloping curve. Here the tenure of bond and here it is yield. Okay, say it is 8%, it is 9%, say it is 10%. So we can see with the increase in the tenure, the interest rates are increasing, yield is increasing. So if we want to value the bond of the 3-year duration, then we shall use this discounting rate. And if we want to get the value of intrinsic value of the bond of 2 year, we shall use this discounting rate. So it goes like that. Okay, this is called upward sloping. And practically normal in most of the cases, in normal situation, this curve prevails. This situation of the curve prevails. Now, student, if you have any doubt in this regarding, please ask me, because this theoretical aspect is very important, because unless and until you understand this concept of term structure, bond valuation will be a quite typical topic for you. But once you understand this concept, then the bond valuation will be the most simplest topic for you. Now, student, I am coming to another situation. This is called downward sloping. Okay, here the shape is basically the concave convexity. So in this case, student, it means if the tenure of the bond is say for a 1 year, so we can say that the securities return is that yield is 10%. Okay. If it is 2 year, it is like that. So 1, 2, 3. Okay. Normally this situation rarely prevails. Now, when it prevails, that so we can assume that the economy may be on a falling side. Okay, there is no growth in the economy. Okay, student. Now there is another situation also. This is called humped yield curve. Okay. So here there is no clarity on the economic situation, that how will it will prevail. that there is a, we can say that it is a kind of a uncertainty in the economy. So here we can say that first initially the situation is like that. For 9%, then it has gone up to, for 2 years it has gone to 10%. Now again for the third year, somewhere it has gone to again 9%. So it is a kind of an uncertain situation in the economy. So the purpose of this yield curve is basically to determine the nature of the economic growth. Here, when we study this flat yield curve, if the flat curve yield is flat, so it means no growth in the economy, no growth perspective in the economy. Economic is very stable. Okay, here upward sloping means the you can say growing economy. You can grow, optimism is in the economy. Okay, optimism in the economy. Okay, and in the case of a downward sloping, we can say that there is a pessimism in the economic situation because people are not sure about what will be the future rate. They are not, so that's why they are not want to invest in the long term. They want to invest from the short term. And an uncertain, it is a kind of an uncertain situation. So this analysis of the sun sector is basically we can say that used for the economic analysis as well as for the valuation of a bond. Now there is a theoretical discussion on the theories of the trust sector. Now so far as the theory of the why the, we can say how the shape of this curve is determined. That is, what determines the shape of the curve. This theory tells we shall discuss under the theories of the term structure. The first is unbiased or the pure expectation theory. According to this theory, it is basically the expectations of the you can say investors that it determines the shape of the this yield curve. Okay, so first theory discuss we, because it depends says that if the investors are expecting that they want to say that they are optimistic about the economy, then okay, of course there will be growth. So they will be saying, okay, that's we shall expect more rate. Okay, we expect the more rate. I just show you how we can compute this this value. Now, for example, or we can say that it can be said that I'm just giving you one liner so that it will be helpful for you to get the knowledge of this concept. That the shape of yield curve here the yield curve is determined on the basis of the expectations. One second. The basis of expectations of the investors. They should note down this line. Okay. So, and accordingly, what happens? Suppose, or we can say that it is a kind of another version is it is the geometric mean. It is a geometric mean of the current short term, that is 1 year rate, and the forward rates. Now I'll just show you by way of example, then it will be more clear to you. Naveen is asking the yields are calculated based on the existing bond price and its maturity, or it is estimated for this purpose. No, student, because it is a yield that determines the bond price. Okay, because I am just that's why I am telling. First, we draw out the yield curve. Like for when we talk about the USA. So USA, normally what happens, this yield curve are basically risk-free rate of interest. Okay, for example, the government is US government, Federal Reserve, they may have some bonds. So their rate of interest determines the yield curve. On that basis, after adding some basis point for the default, etc., that we will discuss when we should take up the topic of credit rating and bonds, then we determine at what rate we can discount the bonds. So first we have to determine the yield curve, then we compute the value of bond. It is not reverse. Now, friend, let us take an example. For example, the 1 year rate is 6.5%. Okay, and market is expecting after 1 year the rate for 1 year bond or money market instrument will be, say, 7.5%. Okay, so now the yield for the 2 year will be, now students see here it is expectation. The word is important, expecting. Okay, it is more important. So it is a basis that after 1 year, the rate for the 1 year bond, 1 year security will be 7.5%. So here for the, we can say 0 to 1, it is 6.5, and from 1 to 2, it is 7.5. So we shall see how we can compute the yield. Okay, let us see how we can compute the yield. The yield can be computed by geometric mean like that. 1 point into okay, 1 minute. Okay, student. So we have to compute geometric mean, or here square root. The value comes somewhere around 0.7. Okay, so it means the yield for the 2 year is 7%. So we can say, we are seeing that if the investors are expecting a boom in the economy, so there is a upward sloping, because 6.25%, 6.5% to 7%. It is an indicator of the upward sloping. Okay, student. So this is pure because it is based on the expectation. It is based on the purely expectation. Now let us see the another version of the theory, and it is called liquidity preference theory. Now, what do you mean by the term liquidity? Liquidity means that you can mature your investment. Now, student, if you recall that when we talk about any financial instrument, when we were used to discuss our your this at intermediate level, so there the liquidity is also plays a very important role. Because what happens, any investment, suppose if I give you a choice, I just am this for example. Say if I give you a choice, there are two bonds, bond A and bond B. Both are offering say 8% interest. It is also offering 8% interest. The tenure of bond A is say 3 years and tenure of B bond is 5 years. So please, I am just taking 1 minute. Please tell me which bond you will prefer. I want answer from you. Yes, I am getting correct answers. Start getting. Student, one has given option A. Student, if we have to presume that other things remain the same, okay, other factors remains to be same. We have to assume like that. Then what will be your answer? Yes, many students have given the correct answer. A student, here we shall opt for the option B. Why? Because here, sorry, my answer is wrong. I'm sorry. Most of our answer will be 3 years. Why? Because here we are getting the benefit of liquidity. Say after 3 years, if I can want to redeem my money, I want to get my money, I have the money because here there is no difference in the interest rate. Both are yielding me the 8%. Of course, I will go for the option that has a less period and I can get the benefit of liquidity. For example, in this connection, Harshit, beta, of course, your answer is correct. Very good. Very good. Now, in this regard, if you maybe your parents may be doing some investment, even you have started investing. Now, student, if you know that there is a post office scheme, okay, there are two post office schemes. One is NSC, another is term deposit. So this NSC is normally carry a period of say 5 years or so, and term deposit is in the multiple of year one. Somewhere the rate of interest, of course, the NSE has some more rate of interest due to compounding effect, but some of they are somewhere near about. Okay, so what happens normally? I have seen that the people prefer this term deposit, though there is some small difference in interest. They say that for NSE I have to lock the money for 5 years, whereas a term deposit, what I can do, I can get the term deposit of 1 year. Okay, from 0 to 1, I make an investment. Okay, after 1 year, okay, I can roll over my investment for another 1 year. Okay, roll over for another. After 2 years, again, I can roll over my investment for the 1 year. So like that, I can getting the benefit at the end of each year. So that is why as per this theory says, if we persuade any investor Now suppose in this, taking this example, now I change the scenario. Suppose if I say this bond is offering, the rate is of 8.5%. Now here, if I ask the same question to you, which bond you will prefer? Now here you will have to think, okay, because I have seen many students have replied quickly 8A. But when I give the situation, this situation, here the student, you will have to apply your mind, because now it will depend upon your preference. Okay, if you want liquidity say after 3 years, then you may go for this option. Okay, but if you have a surplus money and you don't require this money say for another 5 to 10 years, of course you will go for this option. So according to this theory, I'm just writing one liner so that it can be helpful for you. Just you note down this one liner. This theory states that there should be an inducement for long term, and accordingly there should be some compensation for sacrificing liquidity benefit. So in that case, the long-term rate will be always be higher than short-term rate, and accordingly, the shape of the curve will be always upward. So I hope the expectation as well as your liquidity preference theory must be clear to the student. Now I am coming to another version, that is preference, habitat, and the market segmentation. Actually, students, although these theories are normally used combinedly, but I just show you some small differences there. Now, as per market segmentation theory, what exactly this theory says that actually it says that different kinds of investor choice, different categories of investors. I just show you, students. Actually, what happens whenever we talk about the bond investment, as I was told you in the beginning, there are some pension funds, PF trust, they make a huge investment. Okay, on the other side, there is another category. Even the insurance companies. On the other hand, there are banks. Okay, now see, student, there is a different views of each of the investor. Normally, what happens in case of an insurance company? You know that in insurance company, the subscriber to the insurance policy pays a premium, and he takes a he ensures a guarantee that tomorrow if something mishappens, then my family will get the benefit. Now, in that case, say if on a random basis, just I'm saying I'm not actuarial, I'm not actuarial. Say out of say you can say that around say 1900 people or on the death expectancy out of 19,000. I'm not sure the figure about the same. Only 1% claim, 1% will file a claim for the death claim, that is for the claim for the family member of this person will claim for the insurance benefit. Now, in that case, what happens? The insurance company may not require the money on immediate basis, so they may go for the long-term bonds. Their preference will be for the long-term bonds. Of course, similarly, in PF Trust, as I discussed with you, where I was working when I in my previous organization. So I remember that we used to have a analysis of when we shall require the payment, because there was staff who was you were going to be superannuated on a certain date. So accordingly, we used to plan the investment. Okay, Mr. This will be retired on this date, and approximate the amount will be required. So accordingly, we used to manage our securities on that basis. Okay, at least this much of securities we should buy for the same period, so that at the time of a retirement of Mr. X or Mrs. Y, that we should have some money in our account. So now, but these are determined, and normally these are for the long terms. Because suppose a person who has joined at the age of say 22, he will be superannuated from the organizations. If we do the proper service, then he will be likely to superannuated from the service after 38 years. So of course they will make the start investing on that basis. Okay, of course we can go for the long term. So accordingly they go for the long term bonds. On the other hand, normally banks require the money on a short term basis to meet the requirement of the depositor, their withdrawals. Even if there's a one term, asset liability management. This is one of the term where they have to manage their asset and liabilities. You must be have studied this term in your auditing, etc. So here they have to make some investment in the short term bonds. So the difference between their choices, because this is a market segment, this is based on the market. This is called market segment. This is called your market segment theory. It depends on the nature of the investors. Okay. Then there is another version of the same, although it is connected to it. This is called preference habitat theory. As per this theory, I'm just writing here one line, then it will be very clear to you. An investor prefers a particular maturity length over another outside that is outside the maturity preference if risk premium for longer maturity period is available. Now students say, if I say you investor, you invest the money for the 3 years at the rate of 8%. Okay, now I say that, okay, of course, you're investing the money, just invest for the 5 years. So he will say, I will move from my preference if I get some risk premium. Okay, because you understand that when you were discussing the portfolio management, there was a term risk premium. So suppose if I say, of course, I will add 0.50 at a risk premium, then he will say, okay, I'm now ready. So this he will expect 8.50. So of course these theories are combinedly used, but there is a difference. For preference habitat means to come out from their habit, they may be given, have to be some offered some money. So but theoretically you will find these theory combinedly, but there is some little difference. So student, I hope now the theories of the term structure must be clear to you. Now I am coming to the term spot rate curve. You just read the slide carefully, then I make you understand. Now it can be defined as the yield to maturity or the coupon yield to maturity or a coupon on a zero coupon bond. Spot rate curve can be defined. This is spot rate means the yield to maturity on a zero coupon bond. And as you know that zero coupon bond is that does not carry any coupon payment. The spot rate curve can be defined as a YTM on a zero coupon bond on a different maturity. So spot rate means zero coupon bond rate, and spot rate curve means zero coupon bond rates for different maturity periods. Okay, yield to on a zero coupon bond. 1 second. Now student, why we use this spot rate curve? Question arises, why we use the spot rate curve? Now student, we use the spot rate curve because what happens, suppose we have a bonds of different maturity period. Okay, we have a bond of a different maturity period. So, and different rate of interest. So to make them comparable, we determine the spot rate curve. Okay. I'm just writing it down, you note it down. Or I write down here. And this process, just I'm writing down. Just here I write down. To compare the bonds with different interest rate and different maturity periods, we convert them to zero coupon bond curve. Okay, we compare or package them in a zero coupon bond instrument. Okay, so this process is called bootstrapping. The process of constructing of the zero coupon bond from the price of a set of a coupon bearing bonds is called zero bootstrapping. Now, students, please note this term will also be used in the topic merger and acquisition. Okay, but recall that, please remember, there it has a different meaning. Here it has a different meaning. So of course you may get some confusion, but please remember, here it means that when we can say package or change the scenario and we convert a coupon-based bond of a different tenure, different duration into a one single zero coupon bond instrument kind of, we call it as a spot rate curve. So on the base of spot rate curve, we determine in which bond we have to make. It makes our comparable which bonds is giving the good returns. Accordingly, we can write here that this yield of GV is called spot rate, and depiction of these rates corresponding to maturity period is called spot rate. Okay, student. Now there is another term, forward rate. Now, student, just have some patience. We have some discussion on this the theory because it is going to be end. Then we will start our numericals. Then you will understand how we use these terms. Please read the slide carefully. Now, student, forward rate curves means what shall be the rate of the instrument after certain periods for the 1 year. I can say that it is the extrapolation of theoretical spot rates from the yield curve. Okay, now let us take an example. Now suppose there are two investments alternatives are there. Alternative one, okay, buy 2-year bond at spot rate of 8%. Okay. Then another alternative I am giving, buy 1 year bond for instrument at spot rate of 7%, and after 1 year buy another instrument or bond for 1 year. Now here, ultimately the period of investment in these uh, instrument alternatives is the same. Either we go for alternative one, or either we go for the alternative two. Okay. So now we shall see that what will be the rate. Okay, because here the question mark is this rate of interest. Because after 1 year, what will be the rate of this instrument for the 1 year when we will shall be indifferent? Either we go for this or we go for this option. Okay, of course, we shall see that which option we have to go, but we want to compute that rate. At least I should get this much of rate so that I should be indifferent for both alternatives. So we can say like that. The investor will be indifferent to these two alternatives if they produce the same rupee value or bond value over 2 year investment horizon or period. Okay, students. So let us see also diagrammatically. Then it will make you understand more. Now, students, see here. Sorry. Now here the SIP period is 2 years. Okay, this is a period of 2 years, and our investment horizon, I just write it here like that. My investment horizon is for the 2 year. Okay. So if I say the value of the bond is say 1000, okay. Now my yield will be, my rupee value will be, okay. Now in the, this is alternative one. Now if I go for the alternative two, initially I invest the money for 1 plus R1, okay. Then for this period, I will say it will be the treated like forward rate. Okay. So here we have been given the rate of interest for this period is 7%. This is for the 10-year one. Now question mark is what will be the rate for this period? So accordingly, what I do, I equalize this value. Of course, the bond value is here is 1000. So how we compute this rate? I equalize these both values. I say like that. Initially, I will invest this money at 7. Okay, students. So now see how we can compute this value. Of course, FM will be forward rate is equal to 0.901. Say, okay, student. So you can see it is a forward rate. If I am offered for 9.01% after 1 year for the 1 year, then I will be indifferent between these two options. Either I go for 8% for 1 year, 2 years, or I go for the option for first for the 7 year, first year for the 7%, and then for another 1 year, I need at least the rate of interest of 9.01%. So we have shown here how we can compute this 9.0. So this is called forward rate. This is called forward rate, and forward rate after 1 year for 1 year, or it can be presented like that. Okay, somewhere it is written like that, because you will understand this more term when we can discuss the topic of forward rate agreement. This is under the topic of interest rate risk management. There, this term is very frequently used. Of course. So let us move to formula version. Of course, must have understood the logic. But if you want to say, sir, I want to know the formula. Of course, this is a formula based on the simple logic. But here I'm just providing you the formula. For each year, we have to compute separately. Similarly, considering the example, same example if I consider here, Sorry. Now, student, I'm just from the formula here, no problem. Similarly, what we can say, we can also find, suppose if we are given what will be the rate. Suppose I am just changing the example. Suppose we need to find out the rate after 2 years for 1 year. Similarly, this interest is will be 7.5%. Say, okay, here I say that the rate of interest is for the this complete period is 9%. Okay, so what will be this after 2 years? The rate will be for the 1 year. So we can compute the same manner using the formula 1.09 raised to power 3, that is n upon 1.075. Student, what type of curve is in the market segmentation? Now, the shape of the market segmentation curve is not sure, because if there are the person in market segment, if the persons are more, if the bankers are heavy demand for the short term instrument, okay, so of course they may go for offering the higher rate for the short term instrument. So then in that case the curve may be downward sloping. Okay, so it depends on, and if on the other hand the insurance and passive pension funds, they are having a more demand of the long term instruments, so of course the curve will be the rising, because they will be more interested in buying the long term security, and they are offering the higher rates. Very good question, Kamita. Okay, students. Now the resultant figure will be, just compute the figure. Okay, just give me the answer, beta. I'm waiting for your answer. Yes, good. Yes, of course, I'm getting correct answers. Most of the students have sent it, but it is coming somewhere around 12.06. Okay, so accordingly, we can say that Okay, student. So this is a that version. Now, question arises. Please read this slide carefully. Now here, student, it says that in case there is any mismatch between the computed forward rate and existing forward rate, then there is an arbitrage opportunity. What does this mean? It is very important. Okay. Now, even this is practically happens. This is practically happens. I just give you a very small example. Then you will see the importance of this theory. Suppose suppose in the market the rates are like that. 2 year, okay, 2 years, 7.5%. Okay, 3 year, 9%. Okay, the rate are like that available. However, forward rate for 2 to 3 year means after 2 year, after 2 year, 1 year rate of interest is say 13%. Okay, so please note down the figure. 2 year, this is available like that 7.5%, and here it is 3 year, it is available at 9%, and after forward rate for the 2 year, after 2 year for the 1 year is 13%. Okay, now you see how we can take the benefit of opportunity. Borrow money, say rupees 1,000 for a period of 3 years at the rate of say 9%. Okay. Now student, how we will see, let us see how we can make a profit and how we will doing the reverse calculation. Okay, first of all, borrow the money for 10 years. First, invest money for 2 years at rate of 7.5%, and then roll back money for 1 year at the rate of 13%. So let us see our amount after 3 years. How much? Initially, I will make the investment at the 7.5% for the 2 years. Okay. Then another investment I will make at a 13%. Okay, the resultant sum will be 13.5.086. Okay, now repay the loan. Please student note down these all figures. It will help you to understand exactly the concept. So our net profit is 10.3. Okay, now you say, sir, how we came to know this arbitrage opportunity? Now, student, we see we can do our reverse calculation. How we can do the reverse calculation? Here we have given the spot rate for the 3 years, and here we have been given for the 2 years. So we find the forward rate for the 2 year, that is, we can say 2:1, like we can also write like that. FN after for the forward rate after 2 years for the 1 year period. Okay, so in that case we can compute that way. Okay, friend, let us compute it. So student, please see here. Here it says the forward rate should be 12.2%, whereas here the rate is 13%. So of course there is an arbitrage opportunity. So because there is a difference, it is not matching with the 13%. So hence there is an arbitrage opportunity. Okay, student. Now with this we come to the end of our concept on the yield curve and the system structure. Now the question that we were discussing basically was a question number 7, question number 5, 5th. So now, sorry, question number 6 I was discussing with you. So I will continue this question after a small break of 10 minutes. So student, we are going for a small break, and I will come at around 8:40. Okay. Welcome back, student. Now, before I proceed further, I think I received one or two queries. Now, one query is what type of curve is in the spot rate curve? Now, students, type, not it can be downward sloping or it can be upward sloping. Okay, so if the spot rate curve is upward, it means there is a positive outlook. So they are expecting more returns for the long term. And if it is a downward, it means there is you can say there is a pessimism in the economy. Okay, and so far as the type of curve on the preferred habitat curve is there, it is quite always upward sloping because they want some premium. They want some premium, and of course, premium will be on a higher side. Nobody will say that okay, I will offer, I will get, I want discount for my longer period. Okay. So for preferred heavy rate curve, the always most of the cases, maximum cases, it will be on a upward side, upward sloping, and if that we say simply support curve rate, so it can be on a it can be downward or it can be upward. Okay, this depends on the market. Now, student, let us go to the assignment and solve the question. Now, I'm just taking you back to the question number. My mistake. It's the question number fifth. Sorry, students. My sorry, question number six. Yeah. Now, I'm just again reading out the question. Sonic Limited issued 8% bonds, 8% 5-year bonds of rupees 100 each, having a maturity period of 3 years. The present rate of interest is 12% for tenure of 1 year. It is expected that the forward rate of interest for the 1 year tenure is going to fall by 75 points and further 50 basis point for the next year. This bond has a beta value of 1.02 and is more popular in the market due to its due to less credit risk. Calculate the intrinsic value of bond, expected price of the bond in the market. Now, student, I hope now you will be thorough with this term now. So we can say like that FN this. Okay, so here we have got these three interest rate forward rates, and now we shall solving the same because we want to compute the value of the we want to compute the intrinsic value. So first of all, we find the value of interest, and then we shall find the value of overall maturity. For the first year, for the second year, the first year rate of interest will be the same. Plus, I'm writing out here so now students see here, this is 12%. Here this rate is 11.25. So for the first year, it is FN, this is F21 forward rate. It is the same. Now this is F31. Namita is asking, is there any type of a curve for the forward rate? As I told you, it is a type. It is not a type, upward sloping or downward sloping or flat. It depends on the market sentiments. Okay, so it can be both way. Okay, only the when we talk about the theories, then there can be possibility. Okay, student. So this means the value of the present value of interest, and the value of interest will be Now we compute the present value of maturity value of bond. Okay, students. Now we are coming to second aspect, that is relating to the market sentiments, that is beta. Now, student, I need to tell you about this beta concept. Of course, this beta is more used in the portfolio or equity portfolio. Basically, if we talk about the fixed income, for the fixed income volatility for fixed securities, for the volatility of the fixed income securities, normally we use the concept of duration that we will discuss in the next class. And modified duration. That we will discuss in the next class. For the time being here, we are considering since beta has been given to us, it is a kind of an indicator because of its popularity. So we are just simply using the expected value or intrinsic value has been given to us. So we can say like that, intrinsic value. Okay, student. Now I'm coming to the question number 7. Namita is asking, sir, we should write FN2 below 10 and why it is. Let me check beta. Yes, better you can write. Here we can write. It is hardly matters. You can write here like that. No problem. After 2 years for the 1 year, that way you can also write. No problem. But it hardly matters. You can write that way also. No problem. Because then if we write here, then we have to write here like F0, F1 to 1. Okay, like that. Okay. Then F2 to F0, we will like that. F0. If I say here F1 1, then I will use 2 here and 3 here. If I say it is F0 1, then of course 1 is to 1, and here 1 2 is to 1. If we can write it either way, there will be no deduction of marks for your disputations. Your answer should be correct. Your rate should be correct. Otherwise, there is not an issue. The student in this question just makes small correction. Assuming the following spot rates, these rates have been given to us. Compute the forward rate. Each of the following, you just make the correction small for 1 year. Of course, it is always understood because forward rate are normally used, always calculated for the 1 year. But still, I am just giving, okay, for your remembrance purpose, only I am just mentioning. But even if it has not been mentioned in the question, you always will compute for the 1 year. Because they are based on the 1 year concept. Okay, first, can be equal to okay. Now I am coming to second rate. So as we told in the formula, if we apply the formula, even we can draw it logically also. Raised to power 2 upon n minus 1 f3 or we can say that like that also. Mm. One second. Okay, student, we can also do like that or 1.40. Okay, because here It is the forward rate for the 1 year. It is here forward rate for the second year for the 1 year. Okay, so we can do both way. Now we are coming to the fourth year, beta. One point zero four. One second. Okay, madam. This is alternative. Namita is saying, sir, please explain the logic of this formula. See, student, beta. Logic is that, as I told you, if you go by, if you recall that if I am investing for 0 to 1, 2, 3, 4, 5. So first I make the investment for this period, then I close back the investment for 1 year. Here 1 year, 1 year, then again I roll back my investment for 1 year, 1 year, and 1 year. So this is a logic on that basis, because after 1 year, whatever will be the left, I will reinvest it for the another 1 year. Whatever will be the left after 2 years, I will reinvest it for the 1 year. After 3 years, whatever the investment will be left, it will invest it for the 1 year. And after 4 years, whatever investment will be left, I will invest it for the 1 year. It goes like that. Okay, student. Now I'm coming to the last, fifth year. Nimita, if you will go through our lecture again, then you will certainly understand the logic. If you have still have your doubt, one second. Of course, beta, it will be coming. What point? Okay, student. So I hope this question must be clear to you. Now I'm before I think I come to the question number 8. Let us discuss first question number 9. And this question is from your examination, question number 9. Sir, what does this formula says why we take 4 year in numerator? Because I tell you beta. Here, if you are talking about the numerator, then it is for the 4th year. Okay, we are making the investment for the period of 4 years. See here, we are making investment for the 4 year means for the 4 year. That's why we are taking 4 years. Okay, and here if we say investment is for the 5 year, we are taking less than 5 year in the numerator. Now, student, please read the question carefully. Now it says that following are the yield on a zero coupon bond having a face value of 1,000. Okay, so here the yield has been given to us. Please remember this term is very important. Zero coupon bond. Assuming maturity areas and different rates have been given to us, assuming that is as per this, you are required to calculate the implied 1 year forward rates that we have discussed earlier. Expected yield to maturity at a price of 1 year and 2 year zero coupon bond at the end of first year. Okay, student. Now it sounds interesting. Question is very interesting. First of all, we have to find out the forward rate. Now, when we shall calculate forward rate, first of all, we prepare a table. No, here I say maturity, then YTM. Okay, students. Now YTM here is 10, 11, 12. Okay, we shall compute present value factors. Sorry. Now here, this present value factor is basically 1 divided by 1.11 raised to power 2. Okay, this is like that, 1 divided by 1. I'm just writing here for your understanding. You know to write in your examination. Since the value of bond is, face value of the bond is a 1000, we can compute the price. Okay, we multiply this with this, this with this, and this with this. Somewhere around here. Okay, student. Now we shall compute the forward rates. Now for forward rate, I just show you how we shall compute the forward rate. Please see the calculation. For the same 1 year, it will be 10%. It is not an issue because by definition, it will be the same. Okay, but here it has asked for the, so for the first year, there will be not an issue. Now we are coming to this value. For this value, what we do, see students, here it is the price of the bond, zero coupon bond. It means, just see the calculation. Okay, student. Now let us find out this figure. So the figure is coming. 1 second. The figure is coming like that. Okay. Now ultimately it says that if I today invest this much of money, I will get after 2 years 1000 rupees. But here for the 1 year we have an interest rate. So let us compute. So we can say like that forward rate will be because this value is basically for the 2 years. So if we divide this value divided by 1 year, okay, so we will get the forward rate for the second year for the year of 1 year. Okay, students, now we are coming to third figure calculation. Now let us see how we reach about this calculation. As our value zero coupon bond is 71118 for the face value of this, we compute the spot rate. We can say that we can derive the spot rate. Okay. Now let us see the forward rate. Now here we will use this 11%. Okay, or we can say like that, divided by first year rate, and another rate is this. There is a small difference due to rounding up. Sorry, it's my mistake. It's a 489. Just write it like that. 1 second. Sorry, student, my mistake here. Yeah. 1 second. Hmm. 101. Sorry, student, just hold for a second. You will get it fine. 1 divided by 40 divided by yes. Now, yes, we are getting correct answer now. 14.03. So, or we can calculate this manner also. Here we have used only the forward rates. Okay, here we have used our spot rates. So I hope this question must be clear to you. Now we are coming to the question number 8. That is the last question of this term structure. Then we shall proceed further. Please read the question carefully. The question says like that the following data for the government securities calculate the forward rate. Now here we have been given the face value, no interest payment, 1 year and maturity period. So it means it is a zero coupon bond. Since we don't have any interest payment. For the first year, for the second year, it's a 2-year bond. it says that for coupon payment is 10%, and the value is 98,500. Here it says 1000. Coupon rate is 10.5. Its value is 99,000. Okay, so we have to calculate the forward rate. We have to calculate the forward rate. So very simple. First, we calculate the forward rate for this year, because here we have not been given any interest, but of course there will be interest. So we can see like that for the first year. Simply speaking, what we can say like that, 91,500 is equal to 1 lakh discounted by certain rate. Okay, so this rate comes okay, student. Very simple. So 9.3% will be the rate of interest, spot rate. Spot rate or forward rate, whatever you say. Now we come to the second year. Year 2. Here it says 98,500. Okay, it is. Now we just get it like that. Today I am investing 98,500 equal to, I am getting a one coupon payment of 10,000, because my coupon interest is 10%. So 1 lakh into 10% is coupon. Get it discounted by the respective interest rate of that year, and respective rate is 9.3. Okay, 1 plus maturity amount plus coupon payment. I want to know that rate of interest. So when we solve it, we get the value. So here, forward rate for the second year will be 12.63%. Okay, student. Now we are coming to here. That is, here the coupon rate is 10.5%. Accordingly, there were two coupon payments for the first and second year. Then there is a coupon plus maturity period. And accordingly, for the first year, it will be this is for the second year. This value 89,761.7007 upon 1 plus R3. So R3 comes better here 0.11028. Say 11. So here the forward rate for this year will be 11. So I hope with this the concept of forward rate and spot rate and everything must be clear to you. Now you can solve the whatever type of questions are there. You can solve them very easily. Now, student, I am coming to the next topic, and if possible today, we will shall take up the numerical. Otherwise, we shall take up the numerical in the next class. Now, topic is our convertible bonds. Please read the slide carefully. Now, student, when we talk about the convertible bonds, basically convertible bonds mean after a certain period of time, they are converted into the equity share. So the convertible bonds can be of a two types. One is compulsory, okay, another is voluntary control. In compulsory, the holder does not have any choice. Of course, after a certain period of time, the company will automatically convert the price, you can say convert the debenture into the or the bonds into the equity shares. They have no choice. Okay. Whereas in case of voluntary, it has a choice with the investor. Either he can or she can go for the conversion option, and she or he can opt for the maturity. So it is up to his or her choice. But there can be a hybrid in between two, where there is a partly convertible. There can be partly conversion option also there. Their part will be there compulsory converted. Otherwise, you have a choice. Okay, so these there can be different. When we talk about their analysis of the bonds, this is conversion. So first of all, here we have to see some. We have to be very thorough with some concepts. And this is, if I recall that these convertible bonds were, of course, they are, nowadays they are also prevalent, but somewhere around in 1995 or somewhere 1993 or 1994, somewhere I don't recall that, Reliance has come out with this convertible bonds. And I remember that there was one option because they are normally given as a convertible bonds are considered as a bond warrants. Okay, because they are the package. You can say they are just I'm saying convertible bonds basically is a package of three things. Okay, now this is straight value. Another is your conversion value. And third is the option value. Because this option value, what is this option value? What will be the next class of bond value? But it has a separate. So we can say that when we talk about the converter value, the first thing that we cover is the face value of the bond. And as I told you, it is a stick value of bond is present value of interest plus present value of your principal repayment. This is a minimum core value. Okay, student. Now let us see. This is our now next one. Conversion value of the bond or debenture. It is simply, I am just writing down the formulas and we shall discuss later on. I will show you by way of diagram. The conversion value is market price of each equity share into the conversion ratio. Okay, now suppose the market equity price of a share is 30. Okay, one bond is equal to 30 shares. They can be converted into 30 equity shares. So the conversion value will be simply rupees 30 into 30, that is 900. Okay. Okay, now next term is the market conversion price. Now student, what happens? Suppose if you want to go to the market, if you want to buy the shares, and suppose and the number of shares that you want are not available in the market. So what option left with you? You have another route. That is, you can take the convertible bond route. Okay, according to what you do, you buy the bonds from the market and get converted into equity shares. Okay, that is called the price that will cost to you will be called market conversion price. So simply logic, I am paying some price for the convertible debenture divided by conversion ratio. Okay, this can also be viewed as a break-even price. To be indifferent between market acquisition from market or adopting convertible bond route. Okay, student. So this is a minimum price that at this price it is costing to us. Okay. Now next we discuss the conversion premium per share. Now suppose if we have taken the route, it may be possible that we may have some paid some premium because the route may not have cost the same. So in that case, the formula comes. Or I just write it here. Minus. Okay. Right. I think it is clear to you. Generally, what happens? It is expressed as a percentage. Namita Raskin sir, please explain the chart. Namita, beta, which chart you want to get me explain? Otherwise, you can do one thing. I will check the class again. If it will be stopped, then I will explain in the next class. Otherwise, you can just watch our video again. Okay. Because I am not clear on which chart you are talking about, beta. Otherwise, don't worry. You just give me a call. I will explain you over the phone. Now, this premium normally expressed in terms of percentage. Okay, and the and what the formula normally uses, we can say that it is also called. Well, let me check ratio of conversion. It is called the conversion ratio of conversion premium. Ratio of conversion premium. Okay, it is called ratio of conversion premium. So, what is the formula of ratio of conversion premium? Okay, student. So it means we are paying this much of percentage of premium extra above the market. The next term, premium over the street value of debenture or bond. It means, suppose if we can say that it is kind of a premium, that because convertible bond will always carry some premium, because it cannot be go beyond below the you can say the convertible bond price cannot go below trade value of bond, hence it is called, hence street value is called floor value. So accordingly, we can compute the formula as follows. Market price of convertible bond divided by rate value minus 1. Okay, now higher will be the ratio, less attractive will be the bond. Sir, chart relating to convertible bonds. Beta, I have not shown any chart till now. Please remember, I will present you by way of chart. I have not shown any chart, I think. I have not shown any chart. I will prepare your chart. Don't worry. I think I have not prepared any chart. I think you may be talking about this chart. It is not a chart, but see here. Convertible bonds is a, you can say that it is a kind of a package relating to state value. State value means the floor value. It is a conversion value or it's a option value. So it is basically related to these three concepts. So state value means if we hold the debenture or bond till the maturity, so what will we get? If we go for conversion, then it will be. But it is a kind of an option value premium. Normally, this is covered under a separate topic of option valuation, but it is beyond the scope of our syllabus, a computation. So it is simply just there is not any proper chart. It is only presentation. Okay, students. So here we compute the, and higher it is, higher this ratio, the less attractive will be the debenture, because we are paying a huge premium. Because we are paying a huge premium. Okay, student. Now, next one I am discussing with you favorable income differential per share. Now, what is exactly this mean? Favorable income. Favorable income means, suppose if we hold the bond, of course, what we will get? We will get income from coupon interest from the bond. Okay, if we go for the conversion, then what will be our income? Our income will be from the dividend. Our income will be from the dividend. So accordingly, So we can say that what we are losing, it is kind of a favorable income differential per share. So it can be negative or it can be positive if our coupon rate is more than our dividend. Because see, in a market, when we talk about the market equity shares, so where you get value from the two things. One is your capital gain, another is your regular income. Normally, regular income is in the form of dividend. So even sometimes we compare what will be our annual income or we get a regular income from the debenture or the bond, and what will be our regular income from the equity share. So by this we comparing, we can come to know what will be our income differential per share. Now next round we will calculate premium payback period. We will compute the premium payback period. Premium payback period means how much in how much time the premium paid from the share, premium paid for share acquired through convertible bonds will be recovered. Okay, beta. For this we use a formula market conversion premium per share Okay, so this is the formula. Of course, please student remember, you will more understand these formulas when we shall take up the questions. Okay, so I think these are some of the terms associated with your bond. Now, before I want to just explain this all this conversion into diagrammatic form that I have just hold for a minute. I'm just showing you by way of diagram. It is my own presentation. Now, when we talk about the analysis of a convertible bond, it can be viewed from the market share market angle or fixed as a view can be fixed income investment. Okay, when we talk about the same, the formulas that makes us is upload these handwritten notes on the portal. Namita, actually, so far as uploading of these handwritten notes are there, my advice to you, please, student, please refer the lecture again and make your own notes. Okay, because quite uploading of these notes maybe invite some infringement of the copyright. So normally we avoid the uploading of direct notes. Okay, so you can prepare your own notes. Now, student, here we are concerned with the conversion value. Okay, next we are concerned with the market conversion price. Per share. Okay, market conversion price, or it is also called conversion parity price. Another is a conversion premium per share. Okay, ratio of conversion premium. Okay, similarly, we can understand, view this if we consider as a fixed income investment. So our main first analysis will be premium over the straight value of bonds. Second, favorable income differential per share. Okay, so basically what it does, it basically compares. Okay, next is okay. It is kind of an opportunity cost. So student, and I think if I start the question, it will take some more time. What I discuss, I start discussing quickly the risk associated with the bonds. Then we shall take up the questions numericals in the next class. Now, what is this interest rate risk? Now, students, suppose today is the today you may have you have buy you have must buy say 5-year bond at say 8% rate of interest. Tomorrow, after say 2 years over the time, today zero, after the around 2-year horizon, there is a boom in the market. There is a boom in the market, and the 3-year interest rate was has come 8.5%. Now, in that case, you are facing the risk. What is the risk? Because if you are investing at 8%, you are making commitment to yourself at a rate of for a period of 5 years. So it means if tomorrow the rate of interest has become 8.5%, it may be possible that your peer who have invested for the 2 year, okay, then after 2 years he has reinvested amount at 8.5%. He will be getting a benefit of more than you is a 0.85%. Okay, this is from the investor's angle. Now I take this from the angle of the borrower. Suppose that's why the question of coming the bond refunding. Now suppose a company has issued similar. I just read this same example. The company has issued 8% bonds for 5 years. Okay. Now what will happen? Say after 2 years, the rate of interest has say become 7%. So of course the company is paying 1% higher than its peer. So in that case, we can say that it is called interest rate risk. It is called interest rate risk. And what happens in that case when interest rate has risen, the bond carrying 8% will be sold at discount. Okay, so the fall in the value of bond, because if you suppose if you after 2 years if you go to the secondary market and want to sell the bonds, so it will not be sold at 100 rupees, because if I invest 100 rupees, I will get a 8.5% coupon, because as I in the last class I showed you how is the value drive the value. But today I am for same 8% coupon, I will not pay the value of this bond. So how much I will pay like to pay for this? Let me show you. I will like to pay this much of value because I am getting the same value. So it means my value of the bond will be up to 5.88. Okay, student. So you must see that with the rising interest, the value of our bond will fall, and this is the risk in the bonds, interest rate risk. This is the prime risk. This is an important risk. Next is the reinvestment risk. Reinvestment risk means if we say after 2 years, now suppose if we are given the option that say we can say that 1 minute, student, I forgot to explain one thing. Here, that's the reason. Because of this interest rate risk, the curve, interest rate curve, normally upward sloping. Because they want compensation for the higher risk. This is because of this reason. Okay, student? And next is the reinvestment risk means, suppose if we want to reinvest the money, then of course there is a risk that whether the reinvestment will be at the same value or not. For example, if you haven't given the choice, suppose you have to make the investment for the 5 years. So now you have a choice, either you can go for in one go you invest the 5 years, or either you can, another choice, you can divert your investment in such a manner. First you go for a 2 year, then go for another 3 year. Now in that case you carry the risk whether after 2 years the rate will be that much that it will compensate my forward rate after 2 years for the period of 3 years. So this rate should be at least there. Only then there is a benefit. So this is called reinvestment risk. Next risk is call risk. As I told you, there are some callable bonds which can be called up by a company. So of course, you cannot plan your investment. So there it has a risk. A company can call the money, can redeem the bonds as per their choice. So you cannot plan. Suppose if a person has planned that okay, his son is say somewhere around 5 to 6 years, and he has planned that after 15 years I need this much of money. Accordingly, he has made an investment for the 15-year tenure, and he was expecting that after 15 up to 15 years I will get some coupon income, and I will get the coupon income, and I will get the maturity value. Or if I have purchased a zero coupon bond, so it may be possible that I may will get a good amount there. But what happens in between, the company has exercised their call option, and it may be possible that after 4 years the company may have returned back the money. So his planning will be spoiled. This is called call risk. Another risk is very important, that is called default or credit risk. And if you have heard the case of Templeton mutual fund, the around say it somewhere around in I think May 2020, somewhere in the lockdown time. So the company has defaulted. The company could not repay the debenture holders, their mutual fund units holders. So in that case, what happens? This risk means non-payment of interest plus principal, and that's why the junk bonds carry higher interest rate that I have discussed with you, because there is a risk of the default. Okay, sir, with the increase in interest rate, value of the bond also rise. So how it can? No, beta. With the interest increase in the interest rate, the value of the bond downfall. Here you see, please see. The interest rate has risen from 8 to 8.5. The value of 100 rupee bond has come down to 94, because a person will say, why should I invest in an 8% bond when I am investing 800 rupees and I'm getting a coupon of 8.5 or 8 rupee 50 paisa. So why should I buy a bond of for 100 rupees that is coupon paying pays only the rupees 8? Okay, so please see here, the value has fallen. Okay, now next is very important risk, inflation risk. In India, it is also we are facing up. I think and your family your parents or maybe your grandparents, they may be saying that now the time has changed a lot, because the interest they are getting on their FD is that much not proving, because due to high inflation rate, there is a loss. I'll just give you a very small example. Suppose today you invest 1,000 rupees at the rate of 8%. Okay. Sir, can we say that government bonds default risk is zero? Yes, Namita, to some extent, in the government bond, default risk is zero. Yes. But I will also show you, just wait for 2 minutes. I'm just, before concluding, I will just explain you more light on this. Now, suppose you invest rupee 1,000 8% bond. So after 1 year, the bond, you will get rupees 1080. Okay. Now suppose the inflation is during the period is 10%. Okay. So what will happen? The value of actual value of, you can say the real value or the money that you have received will be 1 divided by, this is 1080 divided by 1.10, and value will come 981.82. So you see, we have started with the 1000, but if today's term, the value that I will, if I consider the inflation at 10%, so the money value, the money value of my investment will be, real value will be 981.2. So there will be a fall of 18.18 in the value. So this is called inflation risk. If it is inflation risk is higher, of course my return will be the lesser. Okay, to compensate that, I may ask for the higher return. Now, when you will discuss the topic, we will discuss the topic of foreign exchange risk management. There, then you will understand this concept of inflation risk in a more detail. Now, another is the exchange rate risk. I think student one more risk. Then I think. Okay, student, I think I left you here because time is already over. Because if I start exchange rate risk, it will take some more time, because I will make you understand with the help of an example. So students, with this, I end up my class session here. As if you have any query, you can send me email at SFM. Sorry. Okay. SFM-final@ica.in, or you can contact me. Okay, students. With this, we bring this end to the session. A minute. So we shall continue this session day after tomorrow, and we shall complete this topic there. So till then, please you can whatever you revise what we have discussed today, and then till then, if you have any doubt, of course you can contact me, and in the next class we will come we will complete this topic of bond valuation. After that, the topic of mutual fund will be started. Okay, student. Thanks a lot. Have a nice day.